It was a really bad session on the Aussie share market, but because when we started off in the first hour of trade, we actually saw the market gaining a little bit of ground. If we have a look at what happened on the market, this is the intraday graph, and you can see I've just drawn a line at the 200-day moving average, which is at 5,104 points. We tested that a number of times in the morning and bounced off that mark, but you can see that once we went through it, we saw the selling really accelerating. And the selling was on the big end of town. It does point to institutional selling. It does look like a lot of fund managers selling out of portfolios earlier on and going on holidays early. And that's because if we have a look at where the selling was concentrated, it was really in the blue chip part of the market. The top 20 index down by 0.9%, and that's compared to the mid cap, which only lost 0.5%, and the small cap index, which actually lost 0.4%. The worst losses were in energy and the materials. In fact, this was a day where investors were going into the safety of the defensives, the utilities and the staples, managing a slight gain. But all in all, it does look like some profit taking coming in, not only here in Australia, but also offshore ahead of that FOMC meeting on the 16th and the 17th of December in what's been a pretty good year for investors. In the US investors have gained 25%, whereas here in Australia, we've only gained 10%.
Julia, what do you think? What do you put the chances down of some sort of announcement about QE next week?
If we have
Sorry, tapering, I should say.
I think the market's getting more and more concerned. We did see an article coming out talking about tapering, and of course some of those Fed watchers now pointing to tapering in the month of December. Really, if we have a look at this tapering meeting, it's probably going to be similar to the interest rate meetings that we've seen, where the Federal Reserve evaluates the economic data which has come out and the strength of the US economy to adjust the amount of quantitative easing according to how strong or how weak the US economy is looking. We know that the run of data has been quite good for the US economy, and not only that, overnight we did see that budget agreement coming through, so it doesn't look like we're going to see another government shutdown in January, and that of course was one of the key concerns of the Federal Reserve. So looking like tapering is a little bit more likely. I'm also of the view that we'll see most of the tapering 2014 rather than at the end of 2013, but we could see a baby step, and the market's getting a little bit nervous ahead of that.
In terms of the banks, it's obviously the dividend is what many people enjoy about having money invested in the banks, but what would your expectation for dividend growth be for the banks? I'm hearing a lot of sort of single-digit growth and not very high single-digit growth moving forward.
I think if we have a look at 2004, it's going to be the year to start lightening the load in the banks rather than being overweight the banks. And that's because, you know, this year's been fantastic for bank shareholders. We've seen increases of around about 30%, an all-time record high for some of these big banks, and that's on the back of 8% earnings growth. Now, if we strip out the bad debt portion, which is about 3%, it's really about 5% earnings growth. So on one hand, you've seen 5% earnings growth, but 30% plus in terms of capital appreciation, and that, of course, isn't a sustainable trend. Now, if we have a look at the current financial year, the consensus is for bank earnings growth of 5%, and that's pretty tame. Usually when we're looking at solid companies, we want to see an extra return above the interest rate and inflation because of the extra risk that we're taking. And I think in 2014, the Reserve Bank has said if the Aussie dollar comes down, they're comfortable staying on hold for all of 2014. So I think in the second half of 2014, it's really time to start to consider moving away from some of those high-yielding stocks, because, of course, what's been driving these high-yielding stocks are the record low interest rates here in Australia. And if we start to see rates moving back up in 2015, I think we'll start to see some asset allocation moving away from some of those high-yielding areas.
Where then does the money go if people are looking, Julia, for growth? We heard Henry, Martin both mentioned BHP Billiton. Noel Yates on Market Moves mentioned BHP Billiton yesterday. Your thoughts?
It's absolutely going to be resources. Resources have underperformed over the last 3 years with a huge tumble in the underlying commodity space. In the current financial year, resources probably the wild card, but consensus stands at about 30% earnings growth. We're seeing commodity prices holding up well and even improving, especially in the area of iron ore. And I think the other area to be looking at is the gas space, especially on the East Coast, where we have seen very strong domestic gas prices. We've even seen upgrades from the likes of APA as well as Investra over the last couple of sessions, and these are companies that own gas infrastructure. So things looking pretty good there, and the outlook looking good there, and I'd be looking at companies like Origin Energy and Santos. I think the three themes to look out for in 2014 is is number one, the continued decline of the Aussie dollar. And I think that's going to be good news for stocks like Amcor, CSL, ResMed, Macquarie, Computershare, and Crown. The second thing to look out for is continued improvement in terms of the housing market. And there's a huge number of ways you can play that, either through the building material companies like Brickworks, Boral, Adelaide Brighton, CSR, like a paint company like Dulux, even on the retail side, a company like Harvey Norman, or the development side, if you look at a company like Stockland or Lendlease. And then lastly, I think the cyclical uptick, the market's still hoping for that cyclical uptick to continue into 2014. And that, of course, means still watching those retail stocks. So if we see housing continue to rise, hopefully they'll spill over into retail as well.